get started. And then I gotta go back to today is the end of chapter 2. We got an in class today before the end of class. You have a homework assignment being posted today after class. It's due Monday. So you got 5 days. Shouldn't be too bad. Email me if you have questions. So next week, Monday and Wednesday, is chapter 11, investments. We're jumping to chapter 11 because I want you to start learning some things to try to implement with your Investopedia investments with fake money. And then our quiz is the 18th, so we have a week and a half till the quiz. So, now we're finishing chapter 2. I want to review a couple things. For example, I want to make sure you remember, this is so important, right here. And the only way to get to this number is through this. And so I want to make sure, if I said, hey, someone's assets, some assets are $21,500 worth, and their net worth is equal to $12,100. Now let me repeat this. You just got two pieces of the puzzle. Their assets are at $21,500, and their net worth is $12,100. What you're not being told are liabilities. But you should be able to use algebra or logic to come up with the liabilities. Someone want to, I don't even have it on my sheet here, so I don't know. But what about the formula? What would you do to find liabilities when you're given the net worth and you're given assets but not the liabilities? What's the formula for net worth? Assets minus liabilities equals net worth. There's the formula right there. Here's your unknown. Use algebra, get that by itself. Tell me what you're going to do. Assets minus net worth equals liabilities. Just all we did was add liabilities to both sides, subtract net worth on both sides to get these variables to the other side. I know you guys can go, God, I hated it. So now I want to review a balance sheet. So I want to go to, where's the book? Here it is. I think it's like 52. Nope, that's inflows and outflows. It's 49. No, we didn't do our thing, did we? I want to remind you, a balance sheet has assets at the top, liabilities at the bottom, and then you subtract the total liabilities from the total assets to get the net worth. But I want to remind you the order of the assets. You have liquid assets at the top. You remember what I told you what liquid assets are. Money. It would be the value of something that you have that you could get your hands on, and it's cash as quickly as possible. And usually that's just like a savings account at a bank credit union, a checking account, where you can just go to an ATM and get the money. That would be the liquid. I noticed this one said cash value of life insurance. I don't even know if I would consider that liquid. But for sure, the checking account and the savings account. And if you're at a mutual fund, their version of a savings account is called a money market fund. So sometimes some people consider that to be liquid. And then the rest are other assets. Some people call them long-term assets, other assets, and they're broken into real estate and investments. Just put them all together. Liquid and then other. Liabilities. Current, long-term. What determines whether it's current or long-term? That's right. 1 year is the key word. Something that's supposed to be paid off in less than a year, it's current. If something that's supposed to be paid off in longer than a year, it's long-term. Right? And then you subtract your total liabilities from your assets to get your net worth. There's that review. Cash inflow, outflow, I'm going to page 52. The reason it's important to know the difference between cash inflows and outflows compared to the balance sheet, because on your quiz and on your homework, you're going to be given a statement of something, and you have to indicate whether it's an asset, a liability, cash inflow, or cash outflow. So it's the words that are going to make that important. And I think one of the examples we used a couple days ago was bought a laptop for $350. Asset, liability, the statement bought a laptop for $350? I meant $225. That's way too much money for a laptop. $225. Bought a laptop for $225. Asset, liability, cash inflow, cash outflow. Cash outflow, because you bought the laptop, you paid money for it. But if the statement said, you know, laptop's current value, $1,200. Asset, liability, cash inflow, cash outflow. Asset, it's telling you the value of it. You already own it. And you would put the value of it, if you had to sell it really quick, on the asset on your balance sheet. So even though they're both about laptops, one was describing an asset, one was describing cash outflow. And that's where people get mixed up a little bit, so look at the words carefully. So there's a review for cash inflow and outflow. Here's what the difference is about all these. A cash inflow and cash outflow is basically where your money went in the past. What did we spend it on? What money came in? This is describing the past. This balance sheet, this is describing right now, at this very, whatever the date is at the top, this is the value of everything, this is what's owed on everything, and this is the net worth right now. It represents the current. And then a budget, man, where's our budget? Right there. This represents the future. These are estimates of how much you think you're going to spend. And then you'll go back maybe and put the numbers you really spent, but a budget represents the future. So you got the cash inflow, outflow representing the past. The balance sheet represents now, and the budget represents future. And that's the differences between the three, the main differences. What happens if you spend more than you budgeted? That's $11 of what? I can't hear you. I got the fan on. Thank you. She can't answer all of it. Deficit. But if you spent less than you budgeted, right here, 78 versus 86, $8, that would be called a surplus. You got it. You're ready for the quiz? Take it now?
Yes.
All up for it. Everybody's going to hate you. All right. Oh, I do want to highlight this real quick. How long should you keep your records? Putting stuff in the shoebox. At the end of the year, take the shoebox, wrap it up, put it in the basement for 7 years total. That's my recommendation. I always went by 7 years. Don't get me wrong, IRS, I think they even changed the 7-year deal down to 4 years maybe or something, but stick to 7 years to be safe. Don't turn into a hoarder like me where I have 15 years stuff down there, but 7 years. You're going to throw it out. We're almost done with this chapter. We're coming up to the most important part. I'm going to it now. Got to go. Oh, I didn't even have the slide up there. Darn. We're going to it right now. I don't know what page it is in your edition, but in this one is page 51. And these are the ratios. These are very important. These are for sure on your quiz, on your homework, without a doubt. Start with the top one, debt ratio. The most important thing about these ratios is what is in the what is the numerator, what's the denominator, and would higher or lower be better? Now I want to repeat that because I know it's not about calculating this, it's about calculating this and determining if it's good or not compared to another number. So wherever you're keeping notes, make sure to include higher is better, lower is better for each one of these. Make sure to include that. So we'll start at the top at debt ratio. This would be your total liabilities divided by the net worth. So in this one, whatever that number was for liabilities here, divided by the 12,100, would be your debt ratio. Where is debt ratio coming across in your life? When you apply for a mortgage, almost every financial institution, that is one of the 3 or 4 calculations they do.
Riverfront, attention, this is a drill. Assume there is an emergency in Riverfront. Leave now using the nearest exit. Remain calm.
Come back.
Walk, do
We
not
have a
run.
short lecture anyway.
Tell
so
others
it's
to
gonna be
leave.
okay.
Assist anyone who needs help.
Most people have their coat though if they walked across from another building here or something.
I mean, I had the coat, it didn't help.
It didn't help. Oh. Is that cool? Okay, where were we? Are we ready? I don't think everybody's ready.
Survival of the fittest.
Say again?
Survival of the fittest.
I think that's right. Before everybody comes back, let's look at this. At the end of last class, a couple of us after class were looking at, let's see if I can get there. Do you see the, oh, come on. See this right here? This is a local credit union. If you walk in there and say, hey, I have $1,000, I'd like to invest it right here at the credit union. Certificate of deposit. And based on how much time you're willing to leave your money there, you're committing your money so they can use it, you will get paid an interest rate for leaving your money there. Notice what happens to the interest rates. You can use either column, it doesn't matter. One is because of compounding, one is what really being, but this is actually what you'll receive. Notice the more time that you're willing to commit your money to the credit union to leave your money there, the more interest, the higher interest rates are willing to pay you. See how it goes up every step of the way as time, and that's normal. And that's how it is for most time-sensitive type investments. The longer the amount of time, the higher the interest rate. And then we were talking about, this is United States. They published the rate of returns, or what they call the yield curve, for all of their treasury bills and notes and bonds, just like certificate of deposits at a bank, but you're doing the deposit with the U.S. government. You're saying, you, government, can hang on to my money for a certain amount of time, and here's what you would get in return. And across the top here, from left to right, is short term all the way to 30 years. 1 month, 2 months, 3 months. Hey, U.S. government, I'll let you hang on to my $1,000 for 5 years. Okay. On January 17th, they would have committed to 2.58% per year return on this 5-year investment. The longer the amount of time, the higher it goes. But lately, when we get to the most recent ones that are published, now don't forget, this is the shortest amount of time, and this is the longest amount of time. You go across here, a little bit more time, it should go up a little bit. A little bit more time, it should go up. A little bit more time, it should go up. A little bit more time, it goes up. It goes down. It's going down. It's still below that. So this is, I don't remember how many years this is in this year, but look at how much higher a shorter amount of time investment with the United States government is compared to a longer amount of time. It's the opposite of logic. It's called inverted rates. Now, historically, when these start popping up, it usually means investors that kind of drive these are saying, we think there's something coming, and there's some risk going long term because we don't know when it's going to happen or what's happening. But this happens to be exactly what was going on before the crash at the end of 2008. Not saying there's another crash coming. It's just saying somebody thinks something's coming because look at how many weeks this has been going on. Now, it's when these start inverting is when you should get scared and say, hey, maybe I need to get my money out of the market. If this were real life, and you guys all are going to have money in the market whether you like it or not. You're going to take this degree, you're going to get a job, then you get another job, and before you know it, you've got this retirement thing going on, and it's all invested into the market. And you got this going, and when you start seeing these inverted, right now they're not. Here's 20 years, here's 30 years. If you're going to commit your money for an extra 10 years, you expect a higher return, right? But right before the crash, these started inverting. When you make more money for 10 years compared to a 30 year, which is crazy. So I just want to point that out. Because there's been several years before we saw any inverting taking place, and it's been happening this whole year, and right started at the end of last year. And now we have inverts every day going on. So we were talking about that at the end of last class. I just thought I'd bring it to your attention. Also, I've skipped, I'm going to use Jeremy's portfolios. This is, yeah. I'm going to show you how, when you get to your paper, and you are looking at your history just like this, I'm going to show you how easy it is to determine how much money you made on an investment. This column, total cash value, let me look at it. Total cash value. This is the column you want to use when you're writing your paper to determine if your investment made money or didn't make money. So in this case, this number represents the money you either spent or collected, whether you were buying or selling. And this column number right here always takes the fees into consideration, so you don't have to worry about, do I need to subtract $6.99, do I, you know, or whatever. This does it for you. So I match up. If I look at his ABMD, he bought 31 shares, sold 31 shares, like 2 weeks later. And if I go to this column, he spent, after fees, $9,775.69 or 89, I can't tell from here. And when he sold it, he received $10,806. That $10,806 already has that $6.99 subtracted. This $977 already has this $19.99 added to it. So if you subtract these two numbers, this will tell you exactly how much money was truly profited after the fees. You don't have to sit there and go, am I supposed to subtract the fee or not? Because one of the things you're going to be asked to write your paper is, show me your calculations on the best investment you made for the semester. And so you're going to go back and look at these numbers to figure out which one was the best one. And you're going to write a little bit about it. It's going to be a paragraph. And this is the column you want to use. And anyway, so the other one, that CRON, when he bought 525 shares with a $6.99 fee, he spent, with the fee included, $10,926.99. When he sold it all, with the fee involved, he received, even when the fee subtracted out, $11,826. So the difference, which is about, wow, $900 almost, was profit on that investment in only, what was that, 4 days. That's not even 4 business days, because I think the first was on a Friday and the 5th was on a Tuesday. So it's 2 business days. That's hitting the lottery. This usually happens 3 times a semester, and we got 1, 2, 3 already. But these are the same stocks, so really that's 2. So there's probably 1 more coming, and I want to give you hope. It could be you. And the obvious thing is when I brought up, I almost forgot, medicines. She kind of hit something. We don't know what it is yet because we didn't look at the history, but it jumped her up 8 spots. That's a big jump. You know? So don't lose hope just because you've been in last place for like 3 or 4 days in a row. I don't know. One of them got ahead, hopefully. Do you still have cash available to buy other things just in case? Yeah. Buy a couple other things you think might hit that haven't yet. That maybe just had a downfall, but you don't see any reason why it should have. That's usually the one that comes back up. All right. Let's get back to these ratios, because these are important. Whoops, 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 whoops. Hey, quit looking at that assignment. Man, that was tough. Here they are. What we want to make sure and talk about is what's in the numerator, what's in the denominator, and whether it being higher or lower is a good thing. The debt ratio was the first one we were just talking about, total liabilities divided by net worth. This is going to be done on you when you apply for a mortgage. Almost every mortgage company figures out your debt ratio. So this one is 0.5, and do you think having that be higher or lower would be a good thing when you're applying for a loan? Lower the better. So on a quiz, I might say, hey, so their debt ratio was 0.5, calculate their new one, and tell me if it's now better or worse than it was before. And you calculate a debt ratio, you take total liabilities divided by, there's numbers there, divided by net worth, and if it's lower than 0.5, then you're going to say it's now better. If it's higher than 0.5, then you're going to say this is not better, it's worse, they've gotten worse. Okay? Next one, current ratio. Liquid assets, those are just those liquid ones that's at the top of the balance sheet, divided by current liabilities. The liabilities that are due need to be paid off in a year or less. Those are the current ones. In this case, it's showing a 2, and a current ratio, here's how I read you, indicates $2 of liquid assets for every $1 of current liability, meaning they have the cash available to pay these most current bills that are going to come due here within the next 12 months. And so, do you think having a higher or lower current ratio would be a good thing? Higher the better. Higher the better. Liquidity ratio. Now, this one, you might as well nickname it emergency fund, because this is really how you should measure your emergency fund. And what it is you take your liquid assets and divide by your monthly expenses. Let me say that again. This is the money you could get your hands on right away. Now, in real life, I would add a couple of things to your liquid assets that you say, well, I could cash in this investment, and if I know it's been 2 months already, you know, that I haven't had a job or something, I could cash this in and get the money in time. Maybe add that to it, but this is it. You need to know you're in a job, you think things are going great, and the market crashes, and you go, whoa, there were 400, 500,000 people getting laid off every month after month after that financial crash. And you got to say to yourself, well, there's a chance I might get laid off from my job. Start figuring out what your monthly expenses are. Add your rent, your utilities, you know, transportation, if you have a car payment, things like that. Take all the money you have saved up that you could get your hands on fast in case you did lose your job. Pretend like there's no unemployment involved. Divide by your monthly expenses. This will tell you exactly how many months worth of savings that you have available in case an emergency comes up. And the old saying used to be, you should have at least 6 months. But if it happened today, I would lower that 6 months easily because we happen to be in the best job market I have seen almost in my whole life. Meaning, you could walk out I'm so thankful you're here in college because the temptation to drop out of college and get a job has got to be so huge if you're looking at all. Because there are so many jobs out there that there's not enough people to fill them. And so with that involved, knowing that, if there no financial crash took place and somehow you got laid off from your job, I would say 3 months worth of liquid savings would be a good emergency fund because the job, you know, the odds of you getting a job making similar to what you were making when you got laid off are pretty good. But if this happens after a financial crash, it was taking people up to a year to find another job. And if something like that takes place, you need to say, wow, I need to increase my emergency fund, preparing for what could be possibly a layoff that may take longer than 6 months to get a job. So you got to look at the economy. So you always want to adjust your emergency fund based on what's happening, you know, how long you think it will take. Right now, it's the short, you know, everyone in this room could find a job tomorrow. You know, if you're willing to take just about any job. And they'll probably work around your school schedule because they're that desperate for employees out there. Anyway, next, that's your liquidity ratio. I nickname it emergency fund. Your debt to payments ratio is your most important one on here. This one should be calculated every time you're thinking about using a credit card to buy something. Every time. And the golden rule is that this calculation should never, ever, ever be over 20%. I'm going to repeat that. You're going to hear this in another chapter also, and I know it's going to be either on your quiz or your final exam because it's that important. This calculation should never be over 20%, and before you make a purchase that you're going to put on credit, or you're going to pay it over time, whether it's a credit card or some kind of loan, you should calculate this first as if you bought it and see if it takes you over the 20%. Because if it does, you're making a huge mistake. You're going to be wrapping yourself up in too much debt to where you're not going to be able to reach your savings goals at all. You may think you're going to be able to save, but you always got to expect things to take place that's going to take your money away from you. I always say plan for the worst and hope for the best. But life is going to all throw at you some bad things that happens to every single human that's going to try to take money away from you. Whether your car breaks down, you bought a house and all of a sudden it needs a new roof, that's like, you know, $8,000, $5,000 minimum that you didn't see coming. That kind of thing. So the debt payment ratio is your monthly credit payments. Did we include our car loan on this? I can't remember here. Debt payments, don't include your home mortgage. So it's what you pay monthly on money you owe. If you owe money on a mortgage, that doesn't count. But it's money you owe on a car, your student loan payment that a lot of us had. I know I had a big payment when I graduated. Any credit card debt that you're making monthly payments on, if you fell for the buy the furniture, pay 2 years later deal, and you got to make payments on that, include that. And then you divide it by your monthly take-home pay. This is the amount you get to spend after taxes have been withheld, after the retirement's been withheld out of it. Your take-home pay. Again, monthly amount you're paying on your student loan, your car payment things, divided by your monthly take-home pay. And the target is less than 20%. If you ever watch that Susie Orman show, when people are calling in, should I buy this, should I buy that? Some of the time she's talking about, let's calculate your debt to payment ratio and see if you've met the max, which is 20%. It's such a common rule that you're going overboard if you're going over the 20%, that you're spending too much on credit, that your wants are getting out of control compared to your needs. And the last one is your savings ratio. This is just the amount you save each month. You look back and you see if you're saving. By the way, what is it I said to use as the tool to determine if you're truly saving money? What is it that you should calculate to determine if you're truly saving money each month? Was anybody here? Did we have a lecture? Just making sure. Net worth, remember? Net worth. You've got to calculate your net worth. Because when you get older, you're not just saving money in a savings account. You may be making an extra payment on a loan on a house, or you may make payments on a car. The car's losing value, but you're also lowering the amount you owe on it. Your balance sheet's going to make changes, not just because you're putting money in a savings account. So if you keep calculating your net worth, that is what the determination is if you're truly saving money. And then you look at what your average has been for the last 3 months. And take that monthly average and divide it by your gross, not net, monthly gross income. This would be the amount, if your whole check came to you, no taxes withheld, no retirement, gross income. And then, obviously, the higher the better on a savings ratio. Debt to payments ratio, if I have to say it, lower the better is obvious, lower the better. Okay? And I know you have a question in your future where it says, currently, this is how much somebody's spending per month on a credit card, another credit card, a student loan, and something else. They're thinking about buying a couch. It's $2,000, and they're going to put it on credit, and their monthly payment's going to be $28 a month. Their net take-home pay is this much per month. Should they buy it? You calculate what percent they'd be at if they were to buy it, and if it's over 20, your recommendation is no, that takes them over the 20%. I know that's coming up in your future, so hopefully you guys get that one. Understand what that's all about, the 20% rule. All right? So any questions? It's kind of fast. I think we're done with chapter 2. Let's look at the balance sheet. We talked about it. Blah, blah, right? Net worth. Cash flow, inflow, outflow, budgets. Again, there's your emergency fund. Budget for that's your number one savings goal is an emergency fund. Once you got your emergency fund, now you're saving for something else. I would never buy individual stocks in real life until after you have this emergency fund, and then you wouldn't use that money in the stock market whatsoever. Blah, blah, blah. Budget again. Balance sheet, cash flow, budget. Wait, is this talking about, here we go. Balance sheet. This is telling you where you are now. Cash flow, cash inflow and outflow. This is in the past. And then your budget is about the financial, what your plan is for the future, how much you hope to spend or you think you might spend. That's it. Savings techniques? Oh, there's a lot of people who tell me if they can touch it, they'll spend it. And it's awful, awful. I feel sorry for you if you have that. And you've got to figure out a way to not have that. But, meanwhile, if you truly admit to yourself, if I touch it, I probably will spend it, have money taken out of your paycheck before you touch it. You can have direct deposit. I knew somebody that used to have direct deposit to a credit union on the other side of town where they only had one branch with limited hours. And he told me it would be I'm so lazy is what he told me, that for me to go there to get the money would be such a hassle for me that I probably won't touch it. And sure enough, that's exactly what happened. And that was his formula for saving money. And if you got to go to that kind of extreme, you set up an account at a place where you know it'd be a hassle to have to go get it, then do that. You then go to your payroll department, you just give them the routing number and the account number, you just pull off like a deposit slip, and you are now having money, you tell them how much, and it's automatically sent there without you touching it. And then the rest gets automatically deposited into your regular account where you can start spending it. But if that's what has to happen, that would be the technique I would recommend. Payroll deduction, which is what that is. Time value of money, we already talked about that a lot. That's it. That's the end of the chapter. You ready for the in-class?